Have you ever wondered why Warren Buffett, a legendary investor famous for avoiding technology stocks for most of his career, ended up making Apple his single largest investment? It's a question that has puzzled investors around the world. After all, this is the same Buffett who once admitted he missed opportunities in the tech sector because he preferred businesses he could easily understand. So what changed? Why would one of history's most disciplined value investors place hundreds of billions of dollars behind a company known for smartphones, software, and innovation? The answer is far more fascinating than most people realize. In fact, Buffett doesn't see Apple the same way many investors do. While Wall Street often views Apple as a technology company, Buffett sees something much deeper: a business with extraordinary customer loyalty, powerful brand strength, and a competitive advantage that may be nearly impossible to replicate. And once you understand what Buffett sees in Apple, you may begin to view both the company and investing itself in a completely different way. What makes Apple's story even more intriguing is that Buffett wasn't attracted by flashy product launches or short-term growth projections. Instead, he was drawn to qualities that have guided his investment decisions for decades. Apple generates enormous cash flows, maintains one of the strongest brands in the world, and has built an ecosystem that keeps customers coming back year after year. Think about it. How many people switch away from Apple once they become deeply integrated into its products and services? This level of customer loyalty creates a powerful economic moat, something Buffett has always considered one of the most valuable characteristics a business can possess. But is that the only reason he loves Apple stock? Not even close. The deeper you look, the more you discover that Apple embodies many of the timeless investing principles Buffett has followed throughout his remarkable career. The most surprising part of Buffett's investment in Apple is that it reveals a critical lesson about successful investing. Great investors evolve without abandoning their core principles. Buffett didn't suddenly become a technology expert. He simply recognized that Apple had transformed into something larger than a tech company. It had become a consumer powerhouse with recurring revenue streams, exceptional profitability, and a brand so powerful that millions of customers willingly pay premium prices for its products. This ability to adapt while remaining faithful to a proven investment philosophy may be one of Buffett's greatest strengths. It also raises an important question. How many opportunities do investors miss because they become trapped by outdated assumptions? Another reason Buffett continues to hold such a massive position in Apple is the company's incredible ability to return capital to shareholders. Apple generates so much cash that it can invest in innovation, expand its business, repurchase billions of dollars worth of shares, and still maintain an exceptionally strong balance sheet. Buffett has often emphasized the importance of management teams that allocate capital wisely, and Apple has consistently demonstrated that capability. Every share repurchase effectively increases Berkshire Hathaway's ownership stake without requiring Buffett to spend another dollar. It's a powerful wealth-building machine that aligns perfectly with his long-term investment philosophy. But perhaps the most important factor isn't found in Apple's financial statements at all. At its core, Buffett's love for Apple is a reminder that investing isn't about finding the most exciting company. It's about finding the most exceptional business. While many investors chase the next big trend, Buffett focuses on durability, predictability, and competitive advantages that can last for decades. Apple checks all of those boxes. More importantly, it demonstrates that successful investing often comes from seeing what others overlook. Most people see iPhones, Macs, and new product announcements. Buffett sees a business with loyal customers, extraordinary economics, and the ability to generate wealth year after year. And that perspective may be the real reason why Apple became the biggest investment in Warren Buffett's portfolio. For years, investors around the world assumed that Warren Buffett would never become a major shareholder in a technology company. After all, Buffett built his reputation by investing in businesses he could easily understand. Companies that sold products people used every day and generated predictable profits over long periods of time. So when Apple became the largest position in Berkshire Hathaway's portfolio, many people assumed Buffett had changed his philosophy. But what if the opposite is true? What if Buffett's massive investment in Apple actually proves how consistent he has remained throughout his career? The hidden reason Buffett loves Apple has very little to do with technology itself. In fact, understanding this distinction may completely change the way you think about both Apple and investing. Because while most investors see a technology giant, Buffett sees something far more valuable. And that difference explains why he was willing to invest tens of billions of dollars into the company. The truth is that Buffett doesn't primarily view Apple as a maker of smartphones, computers, or software. He sees Apple as one of the strongest consumer brands ever created. Think about it for a moment. When customers buy an iPhone, they're not simply purchasing a piece of technology. They're buying an experience, an ecosystem, and a brand they trust. This is exactly the kind of business Buffett has always admired. Decades before investing in Apple, he was already investing heavily in companies like Coca-Cola because he understood the power of brand loyalty. Apple, in many ways, follows the same playbook. Millions of consumers eagerly upgrade their devices, remain loyal to the ecosystem, and willingly pay premium prices. That level of customer devotion is incredibly rare, and Buffett knows that businesses capable of creating such loyalty often become exceptional long-term investments. Another reason Buffett doesn't see Apple as a traditional tech company is its remarkable predictability. Technology is often associated with rapid change, fierce competition, and constant disruption. New products appear overnight, and today's market leader can become tomorrow's forgotten company. Buffett has historically avoided these types of situations because they make future cash flows difficult to predict. Apple, however, has evolved into something much more stable. Its ecosystem of products and services creates recurring revenue streams that generate enormous amounts of cash year after year. The company has transformed from a product-focused business into a platform that millions of customers integrate into their daily lives. This creates a level of stability that resembles Buffett's favorite investments far more than a typical technology company. What makes Apple's business model even more attractive is the psychological relationship it has built with its customers. Buffett often looks for businesses that become deeply embedded in consumers' habits and routines. Apple has accomplished this on a global scale. For many people, their iPhone is more than a device. It's a communication hub, a wallet, a camera, an entertainment center, and a personal assistant all in one. The deeper customers become connected to Apple's ecosystem, the less likely they are to leave. This creates a powerful competitive advantage that competitors struggle to replicate. Buffett understands that when customers repeatedly choose the same company without even considering alternatives, something extraordinary is happening. That kind of loyalty can generate wealth for shareholders for decades. Perhaps the most important lesson hidden inside Buffett's Apple investment is that great investors focus on business fundamentals, not labels. While the market argues about whether Apple is a technology company, a consumer company, or a services company, Buffett focuses on the qualities that truly matter: brand strength, customer loyalty, cash generation, and competitive advantages. He doesn't invest based on categories. He invests based on economics. And that may be the real reason Apple became Berkshire Hathaway's most important holding. The hidden secret isn't that Buffett suddenly fell in love with technology. It's that he recognized a world-class business hiding behind the technology label. And once you see Apple through Buffett's eyes, it's difficult to look at the company the same way ever again. What makes a company so powerful that one of the greatest investors in history is willing to invest tens of billions of dollars in it? The answer may not be found in Apple's latest iPhone, its cutting-edge technology, or even its impressive financial statements. Instead, it lies in something Warren Buffett values above almost everything else: a durable economic moat. Buffett has often compared great businesses to castles protected by wide and deep moats that keep competitors away. The wider the moat, the harder it becomes for rivals to steal customers, profits, and market share. When Buffett looks at Apple, he doesn't just see a technology company. He sees one of the strongest economic moats ever built in modern business history. And once you understand the true strength of that moat, you begin to realize why Buffett believes Apple could remain a dominant force for many years to come. At first glance, Apple's products might seem easy to copy. Competitors release smartphones, tablets, laptops, and wearable devices every year. On paper, many of these alternatives offer similar features and specifications. Yet despite intense competition, Apple continues to attract millions of loyal customers worldwide. Why? Because Apple's moat extends far beyond hardware. The company has built an ecosystem that seamlessly connects devices, services, software, and user experiences into a single interconnected network. Once customers become deeply integrated into that ecosystem, leaving becomes increasingly difficult. Photos, messages, subscriptions, cloud storage, apps, and digital purchases all work together to create a powerful level of convenience. And convenience, as Buffett understands, can become one of the most valuable competitive advantages in business. Perhaps the most remarkable part of Apple's moat is the emotional connection it has established with consumers. Most companies sell products. Apple sells trust, identity, and familiarity. Millions of customers don't buy an iPhone simply because they need a smartphone. They buy it because they know exactly what experience they will receive. This emotional attachment creates a level of brand loyalty that many businesses spend decades trying to achieve. Buffett has always admired companies capable of becoming part of people's daily lives, and Apple has accomplished this on a global scale. When customers line up to purchase new products year after year, often without seriously considering alternatives, it demonstrates a powerful form of loyalty that competitors struggle to replicate. This psychological bond strengthens Apple's moat in ways that financial metrics alone cannot fully capture. Another reason Buffett finds Apple's moat so attractive is its ability to generate extraordinary amounts of cash. A strong competitive advantage is valuable only if it translates into economic results, and Apple has consistently delivered. The company's ecosystem encourages repeat purchases, recurring subscription revenue, and high customer retention rates. These factors create predictable cash flows that allow Apple to invest in innovation, reward shareholders, and strengthen its market position. Buffett has long believed that the best businesses are those capable of generating large amounts of cash while requiring relatively little effort to maintain their competitive advantage. Apple fits this description remarkably well. Its moat not only protects profits but also helps expand them, creating a cycle that benefits both the company and its investors over the long term. Ultimately, Apple's economic moat teaches one of the most important lessons in investing. Great companies are rarely defined by their products alone. Products change, technologies evolve, and industries transform. What truly matters is a company's ability to maintain customer loyalty, generate consistent cash flows, and defend its position against competitors. This is the hidden strength Buffett sees when he looks at Apple. He isn't investing in a smartphone maker. He is investing in an ecosystem, a brand, and a customer relationship machine that continues to widen its moat year after year. And that is precisely the type of business Buffett has spent his entire career searching for. A company so strong that competitors can see the castle, but struggle to cross the moat. Most investors think Warren Buffett became enormously wealthy simply because he picked great stocks. While that's certainly true, there's another wealth-building engine working quietly behind the scenes, one that many investors barely notice. It isn't a new product launch, a revolutionary technology, or a spectacular earnings report. It's Apple's massive share buyback program. In fact, this often overlooked strategy may be one of the most powerful reasons Buffett continues to love Apple. Here's the fascinating part. Every time Apple buys back its own shares, Buffett's ownership stake in the company increases without him spending a single dollar. Imagine owning a piece of a business that becomes larger every year while you sit back and do nothing. It almost sounds too good to be true. Yet that's exactly what's been happening inside Berkshire Hathaway's largest investment. And once you understand how this process works, you'll see why Buffett considers share buybacks one of the greatest tools for creating long-term shareholder wealth. To understand why buybacks matter so much, think of a company as a pie divided into millions of slices. Each share represents a small slice of ownership. When Apple repurchases shares from the market and retires them, the total number of slices shrinks. But the size of the pie remains the same, or ideally, continues growing. As a result, Every remaining shareholder owns a larger percentage of the company. Buffett has often praised intelligent capital allocation, and Apple's management team has mastered this strategy. Instead of allowing excess cash to sit idle, the company uses billions of dollars to reduce its share count, effectively increasing the ownership percentage of long-term investors. It's a simple concept, yet its impact can be extraordinary when repeated year after year. What makes Apple's buyback program particularly impressive is its scale. Few companies in history have generated enough cash to repurchase shares at the pace Apple has maintained. The company produces enormous profits and consistently returns a significant portion of that capital to shareholders through both dividends and buybacks. For Buffett, this creates a powerful compounding effect. Even if Berkshire Hathaway never purchased another share of Apple, its ownership stake could continue growing as the share count declines. This silent mechanism works behind the scenes, often receiving far less attention than quarterly earnings or new product announcements. Yet over time, it can contribute billions of dollars in additional value. It's one of those rare financial advantages that rewards patience rather than activity. Another reason Buffett appreciates buybacks is that they align perfectly with his long-term investing philosophy. He has repeatedly emphasized that great businesses should generate more cash than they need to operate. The question then becomes, what should management do with that money? Poor decisions can destroy shareholder value through wasteful acquisitions or questionable investments. Smart decisions create wealth. Apple has demonstrated remarkable discipline by returning excess capital to shareholders while continuing to invest heavily in innovation and growth. This balance is difficult to achieve, but when executed properly, it becomes a powerful competitive advantage. Buffett understands that a company capable of growing its business while simultaneously reducing its share count is creating value from multiple directions at once. Perhaps the most important lesson investors can learn from Apple's buybacks is that wealth creation is often quieter than people imagine. Financial media tends to focus on dramatic events, market volatility, and exciting headlines. Yet some of the most powerful drivers of long-term returns happen slowly, almost invisibly. Apple's share repurchases don't generate the same excitement as a breakthrough product or a soaring stock price. But year after year, they increase ownership, enhance earnings per share, and strengthen the position of patient investors like Warren Buffett. It's a reminder that successful investing is rarely about finding shortcuts or chasing excitement. More often, it's about owning exceptional businesses that quietly compound value over time. And in Buffett's eyes, Apple's buyback machine may be one of the best examples of that principle ever created.